Hello, and welcome back, where we're going to be talking about continuing with our financial statement analysis and talking about solvency ratios. Solvency ratios are used to analyze a company's long-term debt paying ability and its financing structure. There's 4 different ratios that we're going to be talking about today. The debt to assets ratio is computed by taking your total liabilities as a percentage of your total assets. And the ratio measures the percentage of company assets that are financed by debt versus equity. The debt to equity ratio is similar, but it's computed as your total liabilities over your total stockholders' equity. Okay, so here we were looking at total liabilities versus assets, whereas here we're looking total liabilities versus stockholders' equity. The ratio indicates the relative proportions of debt to equity on a company's balance sheet. Creditors and stockholders have different views when defining the optimal debt to equity ratio. Stockholders like a lot of debt if the company can take advantage of positive financial leverage. Creditors, however, prefer less debt and more equity because equity represents a buffer of protection. So there's no right or wrong debt to equity ratios. It really depends on the company's overall leverage strategy. Here's the debt to asset ratio and the debt to equity ratio for the company that we've been looking at. Each year, less than 1/3 of the company's assets were financed with debt, and the amount of liabilities per dollar of stockholders' equity declined. So the debt to asset ratio is 29% of their assets are financed by debt, therefore 71% are financed by equity in 2018. And the debt to equity ratio means that for every dollar of equity, they have 40 cents in debt. The number of times interest earned ratio is calculated as the earnings before interest expense and income taxes divided by interest expense. It is the most common measure of a company's ability to protect its long-term creditors. It's based on earnings before interest and income taxes because that is the amount of earnings that it's available for making interest payments. So here's the number of times interest earned for Mgmt for 2018 and 2017. Obviously, interest is paid only once, but the more times it can be paid, the bigger the company's safety net. So they're in a better position in 2008 because they're able to pay off their interest 6.25 times with the earnings that they have. Here we're going to look at the plant assets to long-term liabilities. So this is your net assets as a percentage of your long-term liabilities. Companies often pledge plant assets as collateral for long-term liabilities. This ratio suggests how well long-term debt is managed to finance its long-term assets. So here we're saying that for every dollar in assets, so for every dollar in bonds payable, we have $3.4 in plant assets. I'm going to move right into profitability ratios. So there's 4 different profitability ratios that we're going to talk about today. The first one is your net margin ratio. And we actually talked about this in chapter 9 when we were talking about our operating margin and how it is a portion of our ROI calculations. This measure describes the percent remaining of each sales dollar after subtracting other expenses as well as cost of goods sold. So for the company, we're saying that the net margin is 2.78% in 2018. So for every dollar of sales, I'm keeping 2.78%, $2.78. Higher is always better, and this is actually a really low net margin. Asset turnover looks at net sales divided by average total assets. Average total assets are calculated as the beginning and ending assets. Again, we covered this ratio in chapter 9 when we were talking about residual income and ROI. So the asset turnover ratios for the company are here. And basically what it's telling us is that the assets are turned over 1.87 times during the year. Asset turnover is going to be high in an industry which requires only minimal investment to operate, such as real estate, companies. On the other hand, industries that require large investments in plant and machinery are going to have lower asset turnover ratios. This should look very familiar since we just covered this in Chapter 9, net income versus average total assets. So ROI here is looking at the financial statement, so we're actually taking average total assets. Whereas in Chapter 9, we're talking about a specific project, so we were looking at just the total assets for the project. Return on equity looks at net income as a percentage of average total stockholders' equity. Whenever you hear the term return on, typically it means that you're going to be looking at net income as a percentage of something. So return on equity is net income as a percentage of average equity. Return on assets is net income as a percentage of average assets. This is a measure often used to measure the profitability of the stockholders' investments. Again, higher is better. And I'm going to pause the video here for our final ratios looking at the company's the company's position in the stock market.